So hi again. So now let us work out some problems on the cash flow statement. So to understand the relationship between the profitability and the liquidity. Okay. So I'll take up to start with. I'll take up a simple problem. The balance sheet. So there's an asset side. So March 13, March 14. This is fixed asset. That's 10 lakhs. And March 14 also 10 lakhs. There's no change. Bank 10 lakhs and 15 lakhs. Current assets, that is central debtors. Opening balance is nil and closing balance is 5 lakhs. On the liability side of the balance sheet, you have equity 10 lakhs for March 13 and March 14. Okay, 10 lakhs and 15 lakhs. There's an increase in the equity. So current liabilities, that is central creditors. Opening balance is 10 lakhs and closing balance is 5 lakhs. You also have a loan. Opening balance is nil and for the year ending March 14 is 5 lakhs. P&L account, there's no profit or loss during the previous year, and current year it is 5 lakhs. Okay, so the total is 20 lakhs, 30 lakhs, 20 lakhs, and 30 lakhs. Okay. So let us prepare a cash flow statement. So let us consider the net profit first. So there is no profit and loss account provided. So we need to see what is the profit for the year. Profit for the year is clearly reflecting in the on the liability side. So that's 5 lakhs for the year. And let us work out the cash flow from operating activities. Okay, so in that case, first let us take up the current asset. The current asset has increased, that is increase in current asset. So that's central debtors. Increase in the current asset needs to be reduced from the profit. I'll explain why in the previous session of the cash flow statement. The reason is the cash flow statement, the current assets increase. When there is an increase, that means the cash is not flown into the company. So the sales that you have made, a part of that, or maybe substantial portion of that, may be sitting in the current asset. That means there is no cash flow, and therefore that needs to be reduced from the net profit. So the next one is the central creditors. Central creditors, there is a decrease in current liabilities. That is central creditors. So this also needs to be reduced from the net profit. This is a negative figure because anything that is not a cash inflow will be put under negative figure. So here also the central creditors has come down. That means the cash has flown out. So in this case, the cash did not come in. There is no cash inflow. In this case, the cash is flown out. So both fall into the same category, and therefore this has to be reduced from the net profit. Okay, so the net cash movement under this excuse me. So the net cash movement with this is negative 10 lakhs. Okay, and then let us work out cash flow from investing activities. So there are items like the fixed asset falls under the category of investing activities, but there is no increase or decrease in the fixed asset, and therefore uh, this cash flow from investing activities, there are no line items appearing under the same. So next is the cash flow from financing activities. And the cash flow from financing activities, we can refer to equity and loan. So there is an increase in the equity. There is an increase in the equity by 5 lakhs. And also there is an increase in the loan by 5 lakhs. So this is a positive figure because there is a cash inflow. Anything, the cash outflow will be represented by the negative figure, and the cash inflow is represented by the positive figure. So here the total is 10 lakhs. So this is not in brackets. So therefore, the total cash movement in the operating activities and investing activities and the financing activities, three put together is nil because a negative 10 lakhs and positive 10 lakhs will offset, and the balance is 5 lakhs. I'm going to add the opening balance of cash and cash equivalent, that is 10 lakhs. So that would total up to 15 lakhs. So that is closing cash balance. It should exactly match to my March 14 bank balance. So this is one simple cash flow statement. So here we have seen that the increase in the current asset uh, denotes that the cash is not flown in, as well as the decrease in the current liabilities denotes that the cash has flown out. So therefore, we have put it into the same category. This represents the actual cash outflow when reconciling to the net profit. So now from the profit of 5 lakhs, we have now reconciled to the bank balance of 15 lakhs. You can see the various cash inflow and outflow as compared to the previous year, the net cash inflow and outflow. So okay, so this is one problem that we made an attempt to solve the cash flow statement. So we'll take up another problem with a little number of more line items so that we understand much better. Subside March 14 and March 15. Okay. So the machinery costing 1 lakh 40, it is increased to 1 lakh 75. So next is vehicle, costing 75,000 is increased to 79,000. Computers, March 14 is 2 lakh 25 and it's 2 lakh 45. Accumulated depreciation, that's a negative because it's contra asset. 1 lakh 2,000 and it has increased to 1 lakh 26,000. Inventory is 2 lakh 25. It has decreased to 2 lakh 5,000. Sundry debtors from 2 lakh 75, it has increased to 3 lakh 29. The cash balance, that's cash and cash equivalent, is 1 lakh 87. It has come down to 1 lakh 79. Okay. So now on the liability side of the balance sheet, March 14 and March 15. The capital is 5 lakhs. There is no change in the capital. Reserves is 3 lakhs and 3 lakh 56,000. Debentures is opening balance is nil and March 15 has a balance of 15,000. The loan from bank is 1 lakh 20 and 95,000. Central creditors 1 lakh 5,000, 1 lakh 20,000. So the total here is 10 lakh 25,000 and 10 lakh 86,000. Okay, so now based on this information, we need to prepare our cash flow statement. Again, here we have not, they have not provided the P&L account. So we need to identify the profit. So the net profit before tax, extraordinary item and exceptional item is, you refer to the reserves. So that's 56,000. Okay, and then we need to add the depreciation. The depreciation would have reduced the net profit since depreciation does not represent the cash outflow. It is the non-cash item. So you need to add back to the net profit. So the depreciation, you can trace it out under the accumulated depreciation line item. So that is 24,000. So this would total up to 80,000. So now let us identify the cash flow from operating activities. So these items are basically the P&L item, that's income and expenditure. So since the P&L item is not provided, anyways we need to look into the corresponding aspect of the income and expenditure that is represented by the current asset and the current liabilities. So the first one is inventory. There is a decrease in the inventory by 20,000. By 20,000. A decrease in asset needs to be added back to the net profit. Sundry debtors, there is an increase. There is an increase in the sundry debtors. So that is 54,000. This should be put under the negative for a reason, because this centric data, there's the cash, there's not inflow, there's no inflow to the extent of 54,000. Therefore, it needs to be put into the negative figure. So then we have centric data. Centric data, there is an increase. There is an increase in the centric data. So this is a positive figure because the cash is not flown outside. So this is 15,000. So the total is negative 19,000. Okay. So now let us identify the cash movement under financing activities. Financing activities. Under the financing activities, we can refer to the capital. Capital, there is no change. There is debenture and loan. We can consider these two. So there is an increase in debenture. So therefore, the increase in debenture means the cash has flown inside. So this is a positive figure. And next is the loan from bank. There is a decrease. Loan from bank, there is a decrease, which means the loan has been repaid. So there is a decrease to the extent of 25,000 because this represents the cash outflow, putting it in brackets. So the net cash movement under the cash flow from financing activities is negative 10,000. Okay. So now let us take up cash flow from use this piece. Cash flow from investing activities. So here we can consider machinery. There is an increase by 25,000. Sorry, 35,000. And vehicle, there is an increase by 4,000. Computers, increase by 20,000. So all these needs to be put under negative figure because these represent the cash outflow. Because there is an increase in machinery, that means you would have obviously bought new machinery. So therefore, the total here is the net cash movement, and this is negative 59,000. Okay. So when I add up all these three, that is the operating, cash flow from operating, and financing and investing, that is equals, that is 19,000, 10,000 and 59,000. So that is 19,000 negative, and again 10,000 negative plus 59,000 negative will give me 69, 79 and 88,000 negative. Okay, so I'm going to add this to the net profit. So the net profit was 80,000. 80,000. So that would give me 8,000 negative. Okay, so now I'm going to add up the opening cash balance of 1,87,000. So this should match to my closing cash balance of 1,79,000. Okay, so this is how the cash flow statement is prepared under the indirect method. So basically, this indirect method, I reiterate that it is nothing but a reconciliation from the profitability to the liquidity position. So we get to know the various line items that are influencing these, the profitability and liquidity. So these are the line items, and I've explained the logic behind why there is increase or decrease also. So these are how you prepare the cash flow statement under the indirect method. So there is also one question from the student, that is there any difference between the cash flow statement and the cash book? This is an interesting question because no doubt we can also make some analysis in the cash book, because that is nothing but that is a pure liquidity that represents the liquidity. But what happens is practically it is not possible for a reason because the cash book maybe in a company's mid-size and the larger companies, they're running into thousands and 10,000 numbers of transactions, which is practically not viable to analyze the transactions. So, but here what happens is we summarize the transaction. We take the net effect of increase or decrease as compared to the previous year, and this is much more easier for us to analyze than going to the cash book and analyzing things. The information is same what is provided in the cash book and in the cash flow statement. These are cash related transactions, but what we consider here is it's the same data, but it's in a different format. So therefore, there are two different things. The cash flow and the cash book are two different things. Okay. So this is about it. And if you have any questions, you may please leave the comments below the video. Or if you have any questions, you may please, you're most welcome. So thank you very much for watching this video. Thank you.